Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly edition of the Economic Review, this time for the week ending September 10th, 2021. So let's start with a look at this week's markets at the close on a Thursday. So slightly positive for bonds, slightly negative for equities. So lower interest rates, some headwinds on equities, down 0.5% on the TSX, down about close to 1% in the US minus 0.2% for EFI, minus 0.8% for emerging markets. But when you bring everything back into Canadian dollars, well, the CAD was under pressure versus the US this week. So that means better returns for your foreign investments. So in Canadian dollars, the picture was actually not too bad. And as I'm recording this, it's 9:15 a.m. on a Friday morning, so before market open. But we had a very good jobs report in Canada, pushing the Canadian dollar higher. But also stocks are in the green this morning, so we'll see where we end up. But we could end up with a more positive week here for global equities, even in Canadian dollars. So price of oil was under pressure this week. CAD lower, euro lower, gold lower. So that means a stronger USD on the week. So talking about COVID, so quickly, but still Israel, the situation is getting better. The US, we're seeing less cases. Canada, we had a bit of volatility. We're still in a favorable position. When you look at the hospitalization rate, well, Alberta seems to be struggling again, an acceleration in the rate of hospitalization. So still a very real risk for the Canadian economy. And as you can see, the other provinces, more favorable picture, but still the trend is upwards. So COVID is still very much inactive. So if we look at the data in the US, so what caught our eye this week was the job openings figure. So if you look at the blue line here, left axis, you had 11 million jobs that are open but not occupied. So the jobs openings in the US. So that's more than the number of unemployed people, and it's been accelerating. So it's hard to get people to go back to work. Businesses are looking to hire, but they can't find people to hire. And the gray line, the gray dashed line here is the ratio of the number of jobs openings to the number of unemployed in the US. So it's at about 1.25. So what that means is that there's 5 jobs that are open for every 4 unemployed in the US. So there's a lot of availability of jobs if someone wants to work. So how do we get people back to work? Well, one solution is that the programs for extraordinary unemployment benefits at the federal level just expired on Labor Day. So people are losing their support. So probably that will be pushing a sizable chunk of the unemployed back to work. But also we are starting to see wage pressure. So if you want to have qualified labor, then you need to pay up. So Walmart was sending the signal, raising the pay in this industry battle for labor. So we are expecting inflationary pressures to be transitory, yes, but maybe transitory for a bit longer than we think. And here, if we start to see some wage pressure, that leads to more sustainable inflationary pressures. So this is something we'll be keeping our eye on. So talking about the labor market now in Canada, we had our jobs report this morning, added the 90.2 thousand jobs in August, led by accommodation and food services. So it was August, it was the summer months, even though we have the fourth wave that's creeping in. We're seeing lots of service sector jobs coming back online. So very strong report. So now we're at 95% of the lost jobs that have been regained in Canada compared to the bottom of the COVID the crisis, compared to 80% in the US. So our labor market is doing actually pretty well these days. So Bank of Canada is still in this environment planning the exit strategy despite the fourth wave. So there's a lot of text here, but yesterday on Thursday we had Mr. McClem making a speech, pretty much staying the course on the exit strategy. So they will be probably hiking rates sometime in the latter part of 2022 if we listen to the message, or if we understand the message correctly. They are still expecting the economy to strengthen in the second half of 2021. And remember that last week I was talking about the GDP for Q2 in Canada, the second quarter, which was negative. uh, Q3 was looking to be a bit of a struggle too. So there was a risk of a technical recession. So just two consecutive quarters of negative growth. So it's not the end of the world if you have just a technical glitch that leads to a technical recession. But still, the Bank of Canada seems to be looking more at the labor market, seeing strength there, and staying the course on the exit strategy. So very important message here, very important positive message on the economy from the Bank of Canada. So looking at the financial markets, so it's more quiet these days. So what I thought I'd do, I'd bring some reasons for optimism and reason for prudence. So let's start with the reasons for optimism. So here's the table. Well, what's the S&P 500 performance after a 15% plus gain through the month of August, like we've had this year? Well, usually if you look at the column in the middle, the rest for the rest of year gains, well, on average, you have 4%, the median is 5%. So you can have some volatility, short-term volatility, but it's not because you had very strong returns over the first part of the year that then after you're set up for negative returns. Momentum is a strong thing in the markets. And what this tells us is that, well, there are some good reasons to be riding this momentum. And on the right, you see the maximum decline below the August 31st close through the year end. So volatility is always a thing in the market. You can't avoid it. But here the average is -5, the median is -3. So volatility, yes, but not extreme volatility. The only exception here would be 1987. We all remember October 1987. So let's hope it doesn't repeat it this year. Another reason is that, well, when you have 7 straight positive months since 1950, so that's a long history here, well, 1 month later, 3 months later, 6 months, and 12 months later, the picture is all positive in the returns that we've seen in the markets in the last 70 years. And look at the second to last stick here, the 6 months later, it's 93% of the times that we've seen positive returns after. So it seems that the momentum is a strong thing and it could be favorable for the rest of the year. If we look at the reasons to be careful, though, here all of the rallies following bear markets, and we see the black line here is the average rally off of the 1967, 70, 74, 1982, 1987, 2003, 2009, and the 2018 lows. So bear markets or almost bear markets. In 2018, it was almost a bear market. Usually we rebound strongly for close to a year. After that, there's a consolidation phase. And after that, you have further growth, again, some consolidation. So it's different than the red line, which is the current situation of pretty much straight up. So we could be set up for some consolidation. We could be set up for some volatility here if history is a guide. So again, another reason to be careful. So that explains why in our funds we remain generally neutral. We're expecting a good opportunity at some point to be putting more money to work, but right now we think that neutral is the place to be given the balance of risks. So what to watch next week? Inflation. Inflation is always one of the top topics these days. So inflation in Canada and the US. Also have housing starts in Canada, industrial production in the States, and the retail sales figures. So that wraps it up for the week. If you want to reach us, ia.ca/economy. You can also subscribe to our newsletter if you haven't done so already. And you can also write at economics@ia.ca if you would like a PDF copy of this presentation. So thanks everyone, and I'll see you again next week.